AI, biotech, and clean energy are reshaping the economy in ways we've never seen before. The question is, how do you participate in that growth without risking your retirement security? In this episode, we break down the opportunities, the risks, and a practical action plan to help you benefit from innovation while still protecting your future.
Hello and welcome back to Retire Stronger, episode 33. I'm John Foard here with my business partner, Bill Kearney. Today we're diving into one of the most talked about subjects in finance right now, artificial intelligence, biotech, and clean energy, and how these innovations are reshaping investment markets and retirement portfolios. We're going to spend a few minutes today unpacking this because it is a big subject. It's exciting, it's complex, and it has real implications for how you, as a retiree or soon-to-be retiree, structure your savings and investments. So, folks, today we're going to cover where innovation is happening, what's hype versus what's real. We're going to cover what the market data is telling us, such as valuations, concentration, historical comparisons, things of that nature. And then the third thing we're going to talk about today is practical steps, how to prepare financially, how to build a balance, and how to protect yourself while still capturing opportunities. So stick around to the end because we'll share a 3-step action plan that will help you prepare your portfolio for the future of innovation without taking on more risk than you can afford. So, Bill, welcome. Say hello.
Thanks, John. Good to be here. And, this is obviously an important topic for a lot of folks out there, not only understanding the different landscape and how it's changing, but maybe potentially how you can tap into that on an investment side, or how you work some of these things maybe into your overall portfolio. So let's start kind of with the innovation landscape here, talking about AI, because it's obviously impossible to ignore at this point. In doing some research for this particular topic, we looked at McKinsey & Company, which is one of the world's largest and most influential management consulting firms. And they estimate that AI could add $2.6 to $4.4 trillion annually to global GDP.
Big number.
John, that's huge. That's like adding the entire economy of Germany every single year. Companies like NVIDIA, Microsoft, and Alphabet are leading the charge. NVIDIA alone, which makes the chips powering AI, has seen its market cap soar past $3 trillion here in 2025. But AI isn't just about chatbots. It's being integrated into logistics, healthcare, diagnostics, financial analysis, drug discovery, and even agriculture. It's all over the place. Goldman Sachs predicts that AI could automate the equivalent of $300 million jobs globally. So think about that, automating 300 million full-time jobs globally. So for investors, this isn't just a tech story. It's a broad economic transformation.
It's huge. A lot of implications here.
Huge. Yeah. I mean, that's just the AI part, right? So biotech is another sector. Huge, enormous long-term potential. The global biotech market was worth about 1.55 trillion in 2024, and it's projected to grow nearly 14% annually through 2030. We've seen a lot of breakthroughs, like some gene editing technology, mRNA vaccine platforms, and obviously all the controversy that goes with those, and new cancer immunotherapies. Moderna and BioNTech went from little-known firms out there to these household names because of COVID-19, showing how biotech can explode on the scene, right? And I mean, you could spend an entire episode talking about the biotech aspect here, and how that's
another huge area that we could dive into, but we don't have that amount of time today.
No, but this is just as part of the overview. The other part here is the clean energy piece, and folks out there are probably pretty up on the clean energy. In 2023, investment in clean energy surpassed fossil fuels for the first time, with 1.8 trillion spent globally. Solar installations doubled in 5 years. Battery storage costs dropped 80% in the past 10 years, and wind energy capacity continues to grow. And so, just for some context, Bloomberg estimates that clean energy could represent 50% of global power generation by 2035. But there's a cautionary tale here, right? Innovation cycles are rarely smooth. In AI, there's a risk of overhype, just like we saw in the dot-com bubble, where 70% of internet stocks went bankrupt, even though the internet itself was, it changed everything.
Hmm.
In biotech, trials fail, right? Over 85% of drugs entering human trials don't make it to market. And then, in clean energy, subsidies and politics matter. Just ask solar investors who saw their stocks collapse in 2011 when European governments cut, the feed-in tariffs into these. So there's obviously, it's not just a straight line and lets everybody jump into these areas, head first. There's a cautionary tale here as well.
Yeah, I mean, it's very true. So we talked a lot about numbers so far. You threw out some really some really big numbers, um, based on what we're seeing and what's happening out there in the market, especially with companies like Nvidia and what's going on in the biotech world. Um, so let's just talk about kind of markets and valuations. Let's talk about numbers and let's talk about risk. So the S&P 500 is more concentrated today than at any time since the year 2000. And what I mean by that is like you have the top 7 companies in the S&P 500, which are Nvidia, Apple, Microsoft, Amazon, Alphabet, Meta, and Tesla. And they make up over 32% of the index. I mean, I don't know. It feels like it could be a bit of a dangerous concentration, right? I mean, you've got 7 out of 500 companies that make up over 32% of the entire index. What are the other 493 companies doing out there, right? Like, it's quite impressive the growth we've seen in those 7 companies. And in fact, in 2023 and 2024, if you stripped out Nvidia alone, the S&P's annual return would have been cut nearly in half. That means one company is disproportionately driving results. And in my opinion, I think you would agree, Bill, we've talked about this in numerous occasions off the air, but I would think that that's not a very healthy diversification, quite frankly. So let's look at biotech. Unless I'm going too quick here, do you think you have anything to add in that little
I
spot
mean,
there?
the devil's advocate here is, I mean, is it? I mean, maybe
Right?
maybe Nvidia is its own index at this point, right? Is that
I mean,
possible?
I don't know. Is it? Oh, did we just create a new index while we were on this episode today?
Right.
The
Your
Nvidia index?
benchmark is now Nvidia. Like you're an aggressive growth investor. Your benchmark is Nvidia. That's what we're going to use, I guess, going forward, right?
Right. So, fair point. So let's move on and talk about biotech. The Nasdaq Biotech Index peaked in 2021, but as of mid 2025, it's still down about 20% from its high. Meanwhile, valuations have come down, which could make it attractive. But basically what I'm getting at here is it shows how volatile the space is. Clean energy, you mentioned it before, tells a very similar story. The iShares Global Clean Energy ETF is down about 25% from its peak, despite rising global investment in renewables. In other words, just because an industry is growing doesn't mean the stocks always follow in the short term. So volatility matters. AI related stocks like Nvidia or AMD often move 3 to 4% in a single day. Think about that for a minute. You have conservative investors out there that would love to see somewhere between 4 to 6% on an annual basis, as far as growth in their portfolio. And here I just mentioned we have 2 different companies, Nvidia and AMD, that we see often move somewhere between 3 and 4% in a single day. That's 3 or 4 times the volatility of the S&P 500. For retirees, Bill, that are drawing income, that's kind of risky. You don't want your monthly withdrawal depending on whether one chip maker had a good earnings call or had a bad day or it could really disrupt your income flow. And quite frankly, history gives us perspective. In the late 90s, Cisco, Intel, and AOL were seen as unstoppable companies, unstoppable stocks. Cisco was briefly the world's most valuable company trading at a PE of over 100. Let that sink in for a second. They were trading at a PE of over 100. Today, the company's still around, but investors who bought in 2000 are still not fully back to break even after 25 years down the road, right? That's the danger of chasing hype. And I think that was kind of the gist of what I was trying to relay here. Don't chase the hype.
Yeah,
Bill,
John.
anything to add?
No, I mean, you're what you're doing is swerving into the area of psychology here, the investor psychology, right?
Agreed.
And you're always running around the office, John, talking about, investor hype and just really, honing in on that. And honestly, I didn't know what you were talking about until I looked up the Gartner hype cycle. I
Hmm.
honestly believe that's what you've been talking about all these years, and it's a brilliant part. I'm going to actually share a chart here so we know what we're talking about, but we've got to talk a little bit about the psychology here because retirees themselves are not immune to hype.
Mm-mm.
When you see headlines like AI is going to replace millions of jobs, right? Or, clean energy stocks are going to double, it's natural for people to want to jump in.
Hmm.
And, if you're watching us on YouTube, you'll see this chart that we put up on the screen here, but it kind of gives you the life cycle here of what is called the Gartner hype cycle. John's a big fan of the Gartner hype cycle, always has been. Um, you know, so new technologies start with an innovation trigger, and then they skyrocket into inflated expectations, and then they crash into the trough of disillusionment, right? And then only then they start to climb out the slope of enlightenment. I know these are kind of maybe new terms or things you may not have heard of before, um, in here, but it's interesting because all of these particular areas seem to fall into this, right? And
Hmm.
you'll see this kind of, it's almost like the trigger, the technology trigger, and the peak of expectations is like this sugar high. It's just like having a sugar high in this area, right? And all of a sudden, at some point, an hour later, you crash down. Well, that's kind of the life cycle that happens here, right? And then once we get to that slope of enlightenment, then there's kind of like this long term, adoption of these new concepts, and they kind of become just known, right? They're customary. AI, biotech, and clean energy are all somewhere along this cycle. And the challenge is that we don't know exactly where we are on the cycle when we're in it, right? Are we in the
Right.
middle of the hype phase? Are we just beginning real adoption? And so that uncertainty makes timing of these areas and investing in timing nearly impossible. And that's why discipline matters, right? That's why you've got to bring yourself back to reality here. Don't get caught in the sugar high, right? Especially retirees, cannot afford to gamble on timing. They need structured exposure, not emotional bets in their plan.
Absolutely. You know, so if we want to stay along the same vein here and talk about, the psychology of all this, it speaks directly to, behavioral finance. And there's an entire realm of the financial planning world that we live in that focuses specifically on behavioral finance. And it speaks to the fact of, you know, not jumping on the hype train and, not getting distracted by that shiny object off in the distance or off to your left or right. And being disciplined with with your financial plan and with what you're doing with your investments from a diversification and asset location and tax management standpoint. These are all very important things to remember. That we're just talking about one element of it here, which is that hype and the risk that can come from it. And well done bringing up the Gartner chart. That was pretty cool. I had no idea you were going to be going to be introducing that in the episode today.
Well, it's
So
technology. I got to use some technology pieces inside the platform, right? I got to be able to pull a screen share up.
absolutely,
We're
absolutely,
participating now. We're participating on the Gartner hype cycle.
absolutely. So so in continuing along this conversation we're having today, let's kind of talk about a practical framework for anyone, quite frankly, but especially for retirees, right? So how, if you're a retiree or close to it, or you're looking to set yourself up in an effective way, so that down the road you can retire as efficiently as you possibly can. You know, how should you be thinking about this? Well, number one, you already have exposure. So if you own an S&P 500 index fund or ETF, you already own the leaders such as NVIDIA and Microsoft. You already have clean energy leaders like Tesla, and you already have biotech firms like Amgen. You don't need to reinvent the wheel. So that's number one. Don't try to reinvent the wheel. Don't try to fix something that isn't broken. Number two, like use satellite investing. You know, your core investment should be diversified. 50 to 60% in broad equities, 30% in bonds, 10 to 20% in income products. Then add a small satellite slice, maybe 5 to 10% of equities for themes such as AI or biotech or clean energy. And remember, folks, we're not making recommendations here. We're just kind of giving broad examples, broad ideas. So if you have questions about your own portfolio, please seek the advice of a qualified professional before making any decisions. And then number three, consider ETFs, not single names. And what do I mean by that? Picking winners is tough. Trying to find the right stock to buy at the right time, it's darn near impossible. If it were not so difficult, people would be, out there crushing it every single day, making the right picks on a regular basis. And it's not happening. So for every NVIDIA out there, there's a dozen AI startups that are going to fail. For every Moderna, there are a dozen biotech firms whose drugs don't get FDA approval. Thematic ETFs give you diversification within the innovative spaces, such as biotech, such as AI. Don't risk all the money on one name. Diversify by using an ETF. And then number four, layer in protection. Use cash buckets, maybe even possibly use an annuity of some kind for guaranteed income, or use a dividend strategy to make sure innovation bets don't jeopardize your income. This way, you're able to afford to wait out volatility, because volatility is going to be there at all times. So again, diversification, asset location is what I'm referring to there when I say layer in some protection in your portfolio. Bill, I'm going to kick it back to you. Anything you want to throw in there that I missed? Or
I was just going to ask, you mentioned seeking the help of qualified professionals. Is that us? Are we the qualified professionals?
Yes, it is. Yes.
Okay. All right. That's what our licenses say, I think. All right. Look, we're going a little long here, so I'm going to give you kind of a concise 3-step action plan here to put a framework together that retirees can act on. Just 3 simple steps, right? The first thing is to assess your current exposure. Look at your portfolio already. How much do you already have in innovation? If your S&P 500 fund is 30% of your equities, well, you've already got significant AI exposure. So you may not need to add any more here. In fact, you might actually need to trim it back a little bit. Who knows? On that part of it, just kind of depends on how far into that you want to go. But assess your current exposure. Then you want to define your innovation budget. Decide how much you can safely allocate. For most retirees, that's 5 to 10% of your equities. Enough to benefit if innovation soars, but not enough to derail your plan if things crash. Right? That's a great way to hedge how you're doing things. And then build a balanced plan. Choose diversified vehicles, broad funds plus 1 or 2 thematic ETFs, right? That are specifically themed for what we're looking for here, right? Anchor them in a retirement income strategy. We use the now, soon, and later buckets. We've talked about that before. So there's ways to layer this in there. And that way your near-term income is secure and your long-term growth can include innovation without the sleepless nights.
Yeah, well said, Bill. And you are correct. We're starting to get a little long in the tooth on this episode. We like to keep them within 20 minutes or so that we're not going too long. So let's just bring this home, right? AI, biotech, and clean energy are not just buzzwords anymore. They're trillion-dollar forces shaping the future of the markets, right? But history shows us that innovation comes with hype. It comes with concentration risk, and it definitely comes with volatility. For retirees, the right move is measured participation. Get exposure, but don't gamble. Build balance, anchor your income, and layer in innovation carefully. So if you would like help reviewing your portfolio and creating a customized innovation strategy, reach out to us. You can email us at info@crownadvisorgroup.com. That's Crown Advisor with an OR group.com. Or feel free to reach out to us by phone, 704-469-0200. Again, 704-469-0200. And folks, don't forget, subscribe to the Retire Stronger podcast on all of your podcast streaming areas. You can choose between Spotify, Apple Podcasts, Amazon Music, and of course, YouTube, so that you never miss an episode. Feel free to pass it along to your friends and family. Would appreciate that as well. And folks, I'm John Foard here with Bill Kearney. Thanks for listening. And remember, the future is full of opportunity if you plan wisely.